Hello friends, today we're taking a look at Procter Gamble, ticker symbol PG. Procter has been down about 5% in the last month. Year to date, they are down about the same amount. They have been trading pretty much since 2020 between 140 and 160. However, in the last 5 years, they're up almost 55%, and they reported earnings not too long ago. They don't report earnings again until January 23rd. Uh, Analysts are thinking that they will trade back all the way to $167 in the next 12 months, and which will give us a possibility of a 17% up. They are encouraging people to buy. So the question is, do we want to buy? Do we want to add this to our portfolio? And that's what we're going to be looking at today. Welcome to my channel. This is Money Talks with Martin Reyes, where I talk about personal finance and try to find great company at great prices. I will encourage you to subscribe, leave a comment down below, like if you like this, whether you're watching this in YouTube or whether you're listening to me in Spotify or Apple Podcasts. I encourage any kind of feedback when it comes to that. So thank you very much for the support, and let's continue. For the remaining of our time, we're going to be looking at who Procter and Gamble is. We're going to be looking at the why are they trading kind of flat in the last 2 years. What are the expectations for the upcoming year? What has the CEO talked about? We look at the 10 year, the last 10 years of financial, and we'll be looking at a valuation, different valuations, and see if we can come up with a fair value and maybe a margin of safety. Who's Procter and Gamble? Well, Procter and Gamble is a company that specializes in beauty, grooming, healthcare, and um, mostly personal hygiene and home care. As you can see here, their 18% of their sales come from beauty, and that is like shampoo and skincare, like Head and Shoulders, Pantene, Olay, Allspice, Secret. When it comes to grooming, 8% of their revenue comes from that, and that includes Gillette, Venus, and Brown. Healthcare, it's about 14% of their sales, which includes Crest, Oral-B, Pepto, Vicks. When it comes to fabric and home care, that is about 35% of their income, and that has to do mostly with Dowing, Gain, Tide, things that we use to um, clean or or clothes, and also in home care we have dishwasher, surface cleaning like Cascade, Mr. Clean, Dawn, and then of course we have baby, feminine care and family care. That's 25% of their income, of their revenue. So we have Pampers, we have Tampons, Always, we have Charmin and Puffs. Uh, so whenever we look at all of that together, we see that fabric and care is 35% of their sales. Baby and family care and feminine care is 25%. Beauty is at 18%, healthcare at 14%, and grooming at 8%. When it comes to international sales, 50% of all their incomes come from North America, followed by 21% in Europe, 9% on China, 8% in Asia Pacific, and 7% in Latin America, and 5% for the rest of the Middle East and India. So, as you can see, they're very diversified. Well, not very, but they're diversified. They're very reliant on American consumer, and this is other areas like Latin America and Europe where they can grow um, in the future. This is why it's beloved by a lot of investors, because they have a very great um, uh, they're they're a defensive company that has a lot of products that a lot of us use all the time, and it doesn't matter how bad the economy gets, we all gonna wanna brush our teeth. We're going to want to use shampoo. We're going to want to clean our clothes. We're going to want to take care of ourselves. So, in the latest earnings report was on October 18. They beat on EPS, and they also beat on revenue, not by too much in revenue. I mean, three $300 million is a lot of money, but whenever you compare it to their actual revenue of almost 22 billion, it's not that much. When it comes to the upcoming um, earnings report on January 23rd. They're looking for they're expecting the EPS to be down from what they did last quarter, and sales to be down also by a little bit. And the last 90 days, they're 50-50 on revisions up and revisions down. So I find it very funny because it just seems like that's the trend. It just goes up and down, up and down. So let's take a look at the finances. When it comes to the revenue, has been growing at a pace of about 2.45% in the last year. In the last 10 years, and the last 5 years is been going up somewhere around 5.5%, which is pretty slow. But they're a big company, so it's harder to make more revenue. I think that one of the things that they will be struggling, as their CEO was talking about, is in the next couple of years he sees that inflation and a lot of cost has been hurting them. But actually, they haven't been hurting them too much, in my own opinion, because as you can see, I will not consider this number because this is taking the 2019 going all the way to 2023. But in the last 10 years, they have been growing about 4.3%, and their earnings have been they were flat all the way before 2018, and since 2020 has been they have been growing on their earnings. Their profit margins are average in the last 5 years is close to 18%, which is pretty good. Free cash flow has been growing slowly at around a pace of 5% in the last 10 years, or 5.5% in the last 5 years, with an average free cash flow margin in the last 5 years of almost also 18%. So it's a company that is very, how will I say it, very consistent. So this will be I think that it will be an amazing company for someone that is maybe looking into moving into their timing life in which they want income, maybe for a dividend investor. If you're a dividend investor, this will be a great company because they're producing very consistent, growing a little bit higher than the normal uh, rate on inflation at 4 or 5%. When it comes to their book value, they have been going down in the last 10 years for 2.3%, and in the last 5 years, they have been going up at 1.4%. So pretty flat, around $20. Their return on invested equity in the last 5 year, um, the average has been 30%, which is great. It's double of what I look for. Their return on invested capital is at almost 18%, which is great, above 15%, what I look for. And return on assets is at 12%, which is also great numbers. I really think that when I look at this company, the current numbers tell me that this is not a company that I should be investing in because they're not producing enough growth. They're not producing a lot of the numbers. Half of the numbers that I look for are not here. However, I also need to consider that, or at least, and once again, this is my thinking. This is not an advice for you or anything like that. I do not make, this is not a recommendation. Do not make financial advice based on me. I'm just a YouTuber. Um, I'm not your financial advisor. But when I'm looking at this, is they're growing at this pace with headwinds, with the last couple of years um, of having problems finding materials and stuff like that. I don't remember supply chain issues. Their dividend has been growing pretty nice. Their payout is a little higher than what I like at 50%, but the dividend has been growing at 4.2% in the last 10 years and at 5.6% in the last 5 years. So once again, if you're a dividend investor, if you're an income kind of investor, you are a little bit older and you are looking into retirement and you want a steady income, this is a great company for it. As a growth value investor, that's where I am kind of going back and forth about this company. This is another great metric. The long-term debt has been growing a little bit at 3.3% in the last 10 years, or almost 5% in the last 5 years. That's not a bad growth. And the awesome thing is that they could pay off all of their long-term debt in less than 2 years with their average free cash flow. So they are financially stable. They have great numbers. The more I talk about it, the more I am thinking um, it's just that I'm looking for a 15% return, a steady, and I don't know if this company can give me this in the next 1 or 2 years. When it comes to outstanding shares, they have been buying back their shares. Their last 10 years, they're buying an average of 1.3%, and the last 5 years, 1.2. So whenever you look at their dividend, which is somewhere around 2.6, and then they're also returning about 1.3, you're looking at almost 4% average return just on dividends and outstanding share buybacks alone. So that's pretty nice. If you add that to the average 10% return on the stock, that gives you a 15% a year. That's a really nice number. Analysts are thinking that they're going to be growing about 7.8%. When we look at the historical multiples, what people have been historically willing to pay for Procter and Gamble, we look at the 5-year multiples. The medium of that, it's giving me a number somewhere between 131 to 146 of a fair price, what people have been willing to pay. When it comes to payback, we're looking at somewhere around growing the cash flow at 7% for the next 15 years. It's giving me somewhere around 160 to 172 as a fair value. When it comes to discounted earnings valuation, it's growing at 8%, discounted back after applying a 23 PE. It's giving me somewhere between 83 to 104, which I think that's very, very low for this company. But at the same time, with Warren Buffett's owner's earnings, is giving me also 112 to 120. So when we put all the numbers together, we're looking at fair value somewhere between 126 to 141, considering all the different issues that they are working on resolving. I probably will be looking at a number of a fair value somewhere around 141. Right now they're at 143. So technically speaking, um, that would not be a value investing strategy. However, I do think that this company will continue to grow. So if this is a company that you would like to invest, if you like the numbers, you like what they're doing, I wouldn't be too worried about jumping in and around 141, just like my fair value valuation. I think they have a great moat, and because of that, they might be getting a little bit of um, what's it called, um, a, uh, a premium. Also, most of their growth has been at 5%, 4 to 5%, and analysts are thinking that that's almost going to double to somewhere around 7.8%. So they might justify paying this and the premium, uh, hoping for that valuation expansion. So anyway, this is my belief, my thoughts. I think I'm gonna stay. I'm gonna be paying attention to this company. I'm probably gonna keep an eye on it. If for any reason were to drop back to the 130, or maybe even have a big drop like this on 125, um, I I will probably be jumping in as a value play. So please give me your comments. Leave subscribe and leave a note. And sorry for the long video. I hope that you enjoy it. Let me know if you have any other thoughts about it or any other videos that you would like me to review. I will appreciate that.